Recently, we've been getting the question a lot, is the stock market expensive? And rightfully so. Anytime that we've had a good performance in the market coming out of a downturn, it brings this issue to the forefront of, are stocks expensive? Are they due for a correction? And of course, there's no way to know exactly what's going to happen because we can't predict the future. But there are some important considerations to think about when we're trying to decide or determine, is the stock market getting expensive? The most common way to take a look at that, to interpret that, is something called a PE ratio. PE stands for price to earnings. It's one of the most widely accepted, commonly used measures of, am I paying too much historically for a stock, a group of stocks, an index like the S&P 500 that's 500 companies weighted? It helps to at least draw some type of conclusion, still an educated guess, of are things expensive or are they fairly priced, or in some cases, in chaotic times, are they cheaper than historically. So price to earnings. So a couple of quick examples so we can get this out of the way of how this works is, let's say an investment stock, whatever it is selling for $60 a share. And let's say that their recent, or what they would call trailing earnings over the past period of time, that they're averaging growing $4 a share of earnings, $4 per share of earnings. You divide those two, and all things being equal, this investment, this company, would be trading at 15 times what they earn. They earn $4 a share, they're selling for 60. An investor right at this given time, based on the past earnings of this investment, is paying 15 times what that stock earns. Another example, what about a company trading at $30 a share, but they earn $1 per share in earnings? You guessed it. An investor would be paying 30 times what that company earns to be able to purchase that share in today's price. So back to the question of, is the stock market expensive currently? It's important to consider a couple of different things. First, you have to consider the past or recent past economic backdrop. Think about what's happened in any downturn, including this past one. We have these often, is earnings of companies stunk. Companies did not do well through this COVID-19 crisis. Some did, a lot didn't. What do you think that that's done to earnings? Of course, earnings have been, in the past few months or quarters, pretty dismal. They've been down. So when we're looking at prices of the market being up today, whether it's indexes or whether it's stocks, and we're comparing some price of an investment, and we're looking at some amount of earnings that are down, and let's say $2 a share, 30 times earnings looks expensive. By the way, stocks typically always look expensive at the beginning of an uptick in the economic activity and the market, because the market has gone up on the investments. The earnings are lagging. The earnings don't look good. So basically what we're looking at is the valuations of what you're paying for the market always seem expensive when the market is in a recovery stage, because a lot of those companies that are in the market are cyclical type companies that are very dependent on the economy. And when the economy didn't do well, guess what? Those companies didn't do well. Their earnings don't look good. But we're talking about the future. And so these prices today, literally, we will know in a few months and in a few quarters if the stock market is expensive today, fairly valued or cheap based on what the earnings are of these companies going forward. If we are in a situation over the next quarters where these earnings of these companies are very strong, investors are pleasantly surprised at the growth of the economy and the growth of these companies, guess what? These prices today won't be as inexpensive, because if this stock is still trading at 60, but these companies start earning $5 a share, that's only 14 times earnings, not 30 times earnings. That's an extreme exaggeration, but we won't know whether these prices are fair that we're paying today in the market till we see the earnings come in. In conclusion, if earnings are good, like we mentioned, the market's probably fairly priced somewhere in here. If, on the other hand, earnings come in far below growth expectations and they are not growing at the rate of the expectation that the market has today and investors have today, the market could be somewhat overpriced. And again, we won't know till we look back in hindsight, but just to know and kind of put it in the back of your mind and remind yourself that stocks typically always, indexes, markets always typically look expensive when things are improving and getting better, because it's like looking in the rearview mirror. We'll know in the near future whether we're in a good place or whether we're not. One last little note to keep in mind: all of you, our clients, everyone that I can think of that we work with has at least intermediate or long-term goals. We bought these investments maybe months ago, maybe years ago, maybe we're adding to them currently. But whether or not the market is expensive on those investments today, fairly valued, or cheap, if you're a long-term investor that's investing over years and not hours, days, weeks, or months, it's not going to make a lot of difference whether this market is overpriced today, fairly priced, or cheap. So just to keep that in mind, it's great to keep up with things, know what's going on, pay attention to what's going on around us. Certainly, we're always trying to keep you informed, but at the end of the day, remember why we're buying investments, why we're doing what we're doing.